Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Lynn & Associates with your agriculture update for this Wednesday, the 19th of July, 2017, getting on to 2:10 in the afternoon. That's p.m. Central Daylight Time. So we were up another nickel in the corn, wheat about steady, down 3/4 cent, and beans up 10 3/4. Now let me prepare you for what's really going on. We're at key times in the corn and the soybeans where too much rain, perfect rain, too much heat, perfect heat. We're going to get those setups. Which ones? And by next week, we will have a pretty good idea as to where these markets are, and that's because here we go into the end part of the month of July, and things are pretty much set up at that point in time in terms of how nature grows the crops. So everybody's watching this very closely. Every time we're getting a weather forecast change, and I'm talking 3-day forecasts, you're getting these markets all over the board. So the market's really geared into the short term. As we take a look at soybeans, the one thing that's evident on a weekly chart, we're having an inside week. That fits right in with this because I expect that to hold that way. And then the way we come out of this come next week, I think is going to be very important. Do we punch through that or do we punch through that? That's how I'm looking at the market. Doesn't mean I'm right, by the way, but I'd love to be that scenario. When we go to the daily charts on the November soybeans, and this is an area chart of closes, you still got this 911, 1043 1/4. You correct down into the 980s, and now you're back up to 1012. Okay, I'm still going to leave that overall thrust in place. I can see where you might want to move it from here to there, though. There'd be no argument with me if either one of those are correct. The swing line does that for you, and you'll see that in a minute. So here we are on the beans on a daily bar chart, and I'm just marking off the swing for you from 907 to 1047. Today you're back up to 1012 and a half. And on the swing line study, you now have a pattern of higher lows but lower highs. Or is it a higher high? What do you think it is? Here's how you find out. Take a look at today's range, 1017 to 996 and a half. If you go to yesterday's range, you've taken out the high and the low. The way that I teach the swing lines, that means you have higher lows, and this high is already higher than that one and a higher high. What you don't want to take out now is 996 and a half, and in theory, it should be all systems go because you've got the 18-day that did a crossover over the 100. If this market's going to make its move, this is pretty much a pattern that it could make its move from. So now we get to see what's going to happen. In terms of Bollinger Bands, wow, if you got a real crazy bull forecast, you could be going to 1068 and a half. On the other hand, take out today's low of 996 and a half, and I'll call that a bull trap, and you could be right down at 980 before you know what's going on. I know you're going to say that's only 16 cents, and I'm agreeing, but if that gives ground, then you're at 966. That's 30 cents, and if you take that all out, you could end up in big trouble. So grain market's notorious for problems, and that's where you're at. Are you overbought? Yeah, you've got a 71 reading on your D line. So you got a 69 on the other. These markets are overbought. They're in an uptrend. They're at a key point on the charts. It's a difficult situation. When you come to the meal market, you didn't have the same pattern. You've been in a pattern of higher lows and, in theory, higher highs. But now I could also argue you got a lower high. So let's assume that that is the case. If you take out 330.10, you can make an argument now you got your higher lows and your higher high, and away you go. Unlike the soybean market, you're not overbought, so this market is primed to go. Let's assume it doesn't go up. What could it do? Well, it could fall back into the 18 and 100-day average of closes. We've had a bullish crossover here, so in theory, everything is set if this market's going to go for it to go and go now. August soybean oil, you've got the pattern of higher lows, right? You see that? Today's high took out this high of 33.72, so you're back into the pattern of bullishness. Now, admittedly, this is the August contract, and soon I'm going to have to switch you over to the next contract month, probably the Septembers that I do, because if you're long past the first of the month, in theory, you can get delivery. Remember that. So you want to get away from maybe that August contract. I'd like to get as close as I can this week to finishing up with this, and then I'll move on, okay? It's still okay to be long because there's no chance of delivery yet. Got that? You're only at the 19th of the month. So this is where the main volume of the market is sitting. In the corn market, big up move today. Now you've got the pattern of higher lows, higher highs. Today's low is very important. If you take out today's low, which is the low of an outside day up, a low of a day where you got back over the 100-day and the 18-day average, well, that would be a real sign of a failure in the market, in my opinion, as a technician. Fundamentally, I couldn't begin to answer that. Momentum has stalled and it's ready to turn to the upside. We'll see if it can do it, but it was a good day on this market in terms of technicals. Now the question is today's low. I think today's a real important day on the charts. In the wheat market, as much as this market led the whole bull parade to the upside, it wasn't Chicago wheat, remember that. It was Minneapolis, a different grain quality of it. This market is tired. And the pros are probably selling this market short if they can get it back to the 18-day average. They won't want to see prices get over 541.5, but no matter how you look at it, you got lower highs, lower lows, and this is the lowest break low, and you're not oversold. You have downside bias because you're under the 18-day average. You have momentum bias down, and the trend is certainly down. Admitted, and you've got to remember this. You're now, if you're going short down here, from the highs, you're almost 60, 70 cents under those highs. So that's a big move. You gotta understand what you're doing with that. In the sugar market, it's getting more and more impressive. Admittedly, it's overbought, but the market is making a stand. And maybe we're going to look back and say this is an important area. Now, does it turn out to be a base? It could. I can see that. You've got the pattern of higher lows, higher highs. You're trying to ride the upper Bollinger Band rather, but you are overbought. It's certainly the way I teach charting, not a fresh buy against an upper Bollinger Band, given you're overbought and on that number. But it is impressive. Yes, you're under the 100-day average, but that doesn't mean you can't work your way higher. I think the pros are taking money off the table against the upper Bollinger Band as well. Got my words screwed there. Coffee, embedded reading, and as I told you, that's the important thing here. Once you get an embedded reading, you look for the markets to run, but I'd be cautious now. You're knocking on the door of the 100-day average. Didn't quite get there. You missed it by about 56 points. You keep hitting that upper Bollinger Band. It needs bull news to keep running here, otherwise a setback is more than likely, but that setback, until you lose the embedded reading, will most likely get bought by the pros. As we get into the cocoa, it's up. So there's something that's evident here on the soft commodities. As the U.S. dollar has been falling, those commodities have been getting a bid. And you can see you got your higher lows, higher highs. You're not yet in overbought territory. You could be there tomorrow with a flash. And a lot of resistance between 1996 and 2007, the 100-day average and the upper Bollinger Band. In the cotton market, as much as it closed lower today, it's still pretty good action. It's staying over the 18-day average. I don't know if it has the power or not to get up to the upper Bollinger Band. It's neither in a buy or sell configuration. It's got momentum up and the bias is up because you're over the 18-day average. But you've got a pattern of higher highs and a lower low. Again, I told you my grammar's screwed today. In the cattle market, up and away you go. Now, you're into the seasonal time where you get a bull market in these again, and the market's acting like that. If you ever used more research, you might want to take a look at those as to what historical studies show. It doesn't mean the market's going to follow it, but you're at that time frame. You've got higher lows, higher highs. And what's important is, like in the bean market now, you don't want to see today's low taken out in the next 2 days. If you do, this will be a trap. as I'd call it, for the bulls. I also think that if you rally much more, you're going to hit that upper Bollinger Band where more resistance is going to uncover itself. Same thing in the feeder cattle. You're overbought, higher lows, higher highs, outside day up. You don't want today's low to be taken out within the next 2 days. And in the hog market, you've come back alive with a higher high, lower low profile. I don't see a trade here at this point in time, so no trend there whatsoever. So when I put it all together, believe me, I'm geared to these markets. I know it's summertime, but it's also an interesting time to trade. Now, I want to talk to you about pivot points because they are so important, and a lot of you responded yesterday. I'm going to redo this ad with my tech people, and I want this to stay up longer, that particular page and this one. You know why? That's how I can show you that you get that center white line, and from there you get 2 buy signals under it, 2 sell signals above it, and you're simply trying to sell at the sell points, buy back at the lowest point, be it the white. So if you're selling the second sell, there's always 2 of them. You're trying to buy back at the first sell. If you sell the first sell, you're trying to buy back at the white line, and then you flip it for the buys. The formula is pretty simple, but I do have a few tricks up my sleeve that I'm going to be making a video for you on. Right now, there's 2 videos. Take a look at them. They're totally free. In one, I teach the PowerPoint of this, and in the other, I show you the actual application on charts, and I'm going to add a third. That's going to come very shortly. How do you get these? Give us a call. You can go to our website and sign up for it. You can click right up here if you're watching me on YouTube, or underneath us on many websites, you can just, it'll say, click here for Ira's free offers, do so, and we'll put it in your hands. I'm Ira Epstein. Thanks for watching, and I will talk to you all later this afternoon in my other videos.